How does the index affect your ARM mortgage? If you are considering an adjustable rate mortgage, or ARM, understanding the index is essential. The index is a key factor that determines how your interest rate changes over time. An ARM's interest rate consists of two parts, the index and the margin. The index is a benchmark interest rate that reflects general market interest rates, while the margin is a fixed percentage added by your lender. Your ARM interest rate is calculated by adding the current value of the index to the margin. This means that at the end of your ARM's initial fixed rate period, your interest rate will adjust based on changes in the index. If the index rises, your interest rate and monthly payments will increase. Conversely, if the index falls, your rate and payments will decrease. This relationship shows how the index directly impacts how much you pay over the life of your loan after the fixed period ends. Common indices used for ARMs include the Constant Maturity Treasury Index and the London Interbank Offered Rate. Each index behaves differently depending on economic conditions. Therefore, the choice of index can influence the stability or volatility of your mortgage payments. For home buyers, understanding the index helps you predict how your payments might change in the future. If you anticipate rising interest rates, an ARM linked to a volatile index could lead to higher payments down the road. For sellers, it is important to note that buyers with ARMs tied to certain indices may be more sensitive to market changes. This sensitivity can affect their ability to afford payments if rates increase. When considering an ARM, here are some practical steps to take. First, ask your lender which index your loan uses. Next, understand how often the rate adjusts based on that index. It is also wise to review any caps or limits on how much the interest rate can increase or decrease at each adjustment and over the life of the loan. Lastly, consider how long you plan to stay in the home. ARMs often start with lower rates but carry the risk of increases tied to the index. In essence, the index is the market-based reference that determines the variable portion of your ARM interest rate. Its movements directly impact your monthly mortgage payments after the initial fixed period, making it a vital factor for home buyers to consider when choosing an ARM.